We talk a lot about taxes and tax increases, tax decreases. The most insidious tax is called inflation. And this is something that is widespread right now, not just in the US, but throughout the world. And it's a tax that people complain about constantly. And yet it appears that they vote for policies that actually cause inflation. And this disconnect is what we're going to discuss today. We have an expert on the subject, Carola Binder from Haverford College, and it's great to have you, Carola, on the show and to have an expert talking about inflation.
It's great to be here, Tom. Thanks.
So if you would, give us a little of your background and how you decided to take this focus and let me mention the book, Shock Values, Prices and Inflation in American Democracy. This is Carola's new book.
Sure.
Why'd you decide to study this? What caused you to focus on this?
Sure. So I'm an economist. I'm the department chair of the economics department at Haverford College. I got a Ph.D. in economics at Berkeley in 2015. So during the years that I was a graduate student, 2010 through 2015, the US was actually struggling with inflation that was too low. It was lower than the Fed's 2% target. And the Fed, they really wanted to try to stimulate the economy, which was still pretty slow after the Great Recession, but interest rates were at the zero lower bound. And so they talked a lot about trying to stimulate the economy through inflation expectations. They wanted people to expect higher inflation, right, to expect it to go up towards the Fed's target. And they thought that would get people spending more and could speed up the really slow recovery from the Great Recession. So it seemed like an opportune time for me to study inflation and inflation expectations and just how and whether central banks can shape people's inflation expectations. That's kind of what how my research agenda started. So I worked on inflation for the first few years of my career, but always with the idea that inflation was pretty low and pretty stable at least in the United States. And that low inflation was really what the Fed was concerned about. So it was kind of surprising for me and for, I think, most other macroeconomists in 2021 when inflation really started rising. And that's when I thought I wanted to kind of try my hand at writing a book. I had a lot that I knew about inflation, but also a lot that I didn't know about its history and about how we got to where we are as far as the institutional arrangements we have in place for dealing with inflation in the US. And I wanted to know more about where those came from, why they are considered legitimate in the US. And that led me to write this book, which was my first book.
That's awesome. So first, let's start with something you just said, which is the Fed wants inflation.
Right.
Why? Why does the Fed want inflation? Because that's, I think, the kind of the base of where, if you want inflation, you get what you basically get what you're asking for. The Fed got what it's asking for; it just couldn't control it.
Right. So Congress has delegated to the Fed its dual mandate. So it has a two-part mandate, which is for maximum sustainable employment and price stability. So that price stability part, Congress delegated it to the Fed, but they didn't tell the Fed how exactly they needed to interpret that. And the Fed decided they interpret that as 2% inflation measured with the PCE price index. So that's around 2.5% for CPI inflation. So yes, they're shooting for 2%, not for 0. There's some reasoning for that. So when they were deciding on the inflation target, some people did say, well, why not pick 0? Part of the reason is that there was some concern that the way inflation was measured was like overestimating it a bit. So they thought, okay, if we shoot for 2%, we'll really get 0. Part of the reason was also they really, really don't want to risk deflation. So they thought, we'll give ourselves a little bit of a buffer, because if we target 0 and we miss it below a little bit, we get deflation.
So why are they so afraid of deflation?
Yeah, I think it all basically goes back to the Great Depression. Deflation during the Great Depression was really, really bad, right? When you have deflation and people expect it to continue, then people are going to want to wait to buy things because they know the prices are going to be lower if they just wait. But then that means that people stop spending because they're all waiting. Then there's no demand, prices fall further and further, and you can get into like this deflationary spiral. So that's like the bad kind of deflation. There are examples of more benign deflation, which is just productivity is increasing, so prices fall, right? That's kind of a good thing, but they really don't, I think they're really worried about the bad kind of deflation.
So,
The
so,
other
so,
thing is,
so, so basically, the way I look at it is it's a confidence game.
a lot of central banking, yes, is a confidence game. They need people to believe that they're going to do what they say and kind of believe that the economy is going to be running along how they,
Right. And if they lose confidence, and so I do have a, since you've been looking at the history, I've got a historical question for you. Ben Bernanke, this is his whole thesis. He like his whole life was devoted to, we don't want another depression. So were the Fed chairmen before him, like Greenspan, were they as pro a little bit inflation as Bernanke?
Yeah, so Bernanke was certainly the one who was an expert in the Great Depression, and there's kind of famously at some event in honor of Milton Friedman and Anna Schwartz, he said about the Fed, like, and the Great Depression, you were right, we did it, we won't do it again. Like he thought the Great Depression was the Fed's fault because they allowed that deflation to happen. And he said, we're not going to let that happen again. And so he was the one who was a big proponent within the Fed of having a formal and explicit inflation target. Some of his predecessors or his precursors, like Greenspan really didn't want to commit to a specific target. He wanted it's even been called the Greenspan standard, right? He didn't want to say it's going to be 2% or it's going to be 0% or 3%. He wanted to just have that discretion and have people trust him as Greenspan rather than the Fed with its target. But yeah, under Greenspan, we also had inflation kind of running along at sometimes around 3%, and he wasn't trying to bring it down to zero. He was just trying to keep it in that low range. And it wasn't.
So let me go on to kind of the standard definition that I learned in college of inflation is too much money chasing too few goods. So first of all, do you subscribe to that definition? And second of all, the Fed can't do anything about too few goods, right? They can only do about too much money.
Yeah, I mean, I would define inflation as the rate of change in the aggregate price level. And yeah, when inflation is high, that's a good way to summarize the reason: too much money chasing too few goods. So that means inflation can come from the supply side or the demand side. It's how they
you can have too few goods or you can have too much money.
Right. And it's how they both balance. So it comes from both sides, but it's like if it suddenly increases, it might be that there's too few goods. It might be that there's too much demand or too much.
Right. So it seemed like that the Fed, when they said for, in my opinion, way too long that inflation was transitory, that they were looking at, well, that's a supply chain interruption. That inflation was coming from too few goods. That's going to change as we get past the pandemic, and therefore we won't have inflation anymore. But what they clearly failed to take into account were the trillions and trillions of dollars that the government put into the economy during and after COVID. So it seems to me that that's where inflation came from, that yes, we had a spike in inflation, but it was a temporary spike based on too few goods. Do you feel like we still have a goods type of inflation, or do you think it's purely too much money?
I think that, yeah, during the pandemic and in the kind of in the months after the pandemic, it was a mix of both supply side and too much, as you're calling it, too much money or too much nominal income. So you can look at nominal GDP as kind of was above where its trend would have been before the pandemic. I think a lot of those big supply chain issues have gotten resolved. And now it's a matter of bringing demand back kind of down into balance. The Fed's just trying to do it very, very gradually so they don't risk some kind of recession. But there's always some supply issues, right? There's always geopolitical events going on. There can always be oil market disruptions, other commodity market disruptions. But in general, it was I think more recently it's been a demand side issue.
So the Fed's role seems to be tightening, but why is it? This is something that seems to me to be a disconnect, because you have the Fed saying, well, we're in charge of bringing inflation down, which we can only do by tightening the money supply. They don't have a lot of tricks in their bag. On the other hand, the government could do it in a number of ways. The government could do it by stop putting so much money into the economy. For example, the Biden's budget this year suggests a $5 trillion tax increase, and of that tax increase, over $4 trillion of it is going to be new money into the economy, right? So they're taking money out, but they're taking it from people who are investors, not consumers, right? Because the $5 trillion is coming from the wealthy, they say, or at least they say it's coming from the wealthy. So if it's coming from the wealthy, then that means it's coming from people who aren't spending on a daily basis, but it's going to people who are spending on a daily basis. So wouldn't that cause, an influx of money into the economy?
Yeah, in general, if you're shifting money from the hands of people who have a low marginal propensity to consume, so wealthier people who, if you give them $1, they're not going to just increase their spending by a full dollar.
Right.
But lower income people, you give them $1, they might spend it all. So if you're kind of transferring money from the first group to the second group, then that's going to increase spending, which is all else equal going to increase inflation. The thing is, the Fed's job is kind of, no matter what the rest of the government does, they're supposed to just get inflation back to target. So if the government decided they're going to pass this huge fiscal stimulus, the Fed needs to recognize that that's going to be inflationary and they need to tighten monetary policy. If the government says we're going to be really have fiscal austerity, then the Fed needs to do the opposite. So that's called monetary dominance, where no matter what the rest of the government does, the Fed is supposed to just kind of keep track of that and offset it and bring inflation to target.
So the government has no responsibility for this.
Well, so they have delegated responsibility for price stability to the Fed, but they can make the Fed's job harder or easier. So if they do something that's going to otherwise be really inflationary and make the Fed have to offset it, that's going to mean more pain for everyone because higher interest rates. So if the government were to say, okay, we're going to pass a huge stimulus, we're going to send everybody checks. Okay, that's going to cause a lot of, if the Fed does nothing in response to that, inflation would really go up. The Fed is not supposed to do nothing. They're supposed to raise interest rates to offset it.
Right. So let me ask you about this, because I get a little confused here. So the Fed raises interest rates, which certainly lowers asset prices, because people don't buy houses. People aren't selling houses right now because they've got low mortgages. Why would you sell a house? You see baby boomers aren't downsizing because it's more expensive to downsize than to keep the house they're in. Okay. So the Fed does affect asset prices, but consumers presumably aren't determining what they spend based on what the interest rates are.
Well,
so how is the Fed to me, the government would have so much more. It's so much easier for the government to control this than for the Fed to control it.
Well, so if the Fed raises interest rates, right, they raise the federal funds rate, then other interest rates are higher, like mortgage rates, like you said, but also credit card rates. So that may mean that consumers would spend less, right? Because they're going to be paying a higher interest rate.
Because they're going to have less money to spend.
Or
because
And
they're
trade-off.
they're paying interest to the banks.
Yeah, or their trade-offs different. Maybe you have money in some investment accounts or in a checking account, and if it's not earning much interest, like you might as well spend it. If you're earning a lot of interest on it, then there's a bigger opportunity cost of spending it. So if people are thinking about that, then higher interest rates should slow down spending.
So you mentioned that the Fed's job is to actually counterbalance the government's what I think are reckless spending policies. And so what that means is, so if you look at, let's turn to modern monetary theory, or as my wife calls it, magic money theory, that as Stephanie Kelton puts it in her book, you can put all the money you want, you can print all the money you want, because all you have to do when inflation gets out of control, if inflation starts getting out of control, is tax it back. That's her statement of the theory. The challenge is politicians don't tax the right people, because they give it to the consumer, but they take it from the investor. So how do you reconcile that? I mean, isn't that just a recipe for disaster?
Yeah, so that's kind of the same issue we were talking about earlier, where different people have different marginal propensities to consume. So if you really wanted to slow down inflation by taxing people, I mean, it would be most effective to tax like lower income people, but of course that's it's politically impossible. It's also not like socially desirable. So yeah, so I don't see it really.
Well, and yet here's the paradox. Inflation is a much more regressive tax than income tax. It's not even close. And inflation hurts the low income person way more than it hurts the wealthy person, because as a percentage of their consumption, it's a much higher percentage of the poor than it is the wealthy. So you're saying that, so basically what the government is saying is, well, if we actually say we're taxing, then we're in trouble at the polls. But if we actually tax higher, with inflation is much higher tax than income tax on the poor. In fact, the poor don't pay any income tax. I mean, the true poor pay no income tax. We have such a high, such high exemptions, et cetera. They're not paying income tax. They're actually getting money back, typically, earned income credit, et cetera. So that's basically what I'm seeing, is that the politicians are saying, well, you'll vote for me if I just spend money because you think, well, I'm going to get that money, not realizing that that's going to be a tax on you because it's going to be inflationary, but your wages are never going to keep up with inflation if we have inflation over that 2 to 3% threshold. So, so my question is, I think that's just a fact. And I don't think politicians are going to change because how would you change it? In other words, to me, it's an education issue, because people don't see that connection. And you talk about that in your book, about how people tend to vote for inflationary policies, and yet then they complain about the inflation.
Yeah, so inflation has redistributive effects, right? It affects certain people more than others, but through a variety of different ways. So another thing that inflation does is it changes the real value of debts, right? Most people's debts are nominal. They're not like indexed to inflation. So if you are in a lot of debt, inflation does actually help you because it reduces the real value of your debt. If you're a creditor, inflation hurts you because it reduces the real value of what you'll be paid back. And that's not the main channel we kind of think of nowadays. We more think about, okay, inflation also reduces your real wages, and maybe that has a bigger effect for some people than others. But in a lot of the history that I talk about in the book, it was that debt part that was actually the really big issue. So for that reason, you actually saw kind of the poorer people, especially farmers, pushing for more inflation, because they would be going into debt to like buy their farm equipment, their land, their seeds. So they would have all this debt. so the last thing they wanted was deflation, because then they would have, their debt would actually increase in value. They wanted inflation so that they could pay off their debt more easily. So you actually had like the richer people who were the creditors, they were the ones who wanted the gold standard, keep prices stable or even falling a little bit. And it was the kind of the masses, the farmers wanting inflation. But yeah, so it's not totally straightforward whether inflation always hurts the poor more than the rich. It also just depends on the whole mix of assets and debt and how much cash people hold and what how closely their wages move with inflation or not.
So
But
it would seem like who it hurts the most are savers.
it does hurt savers, yes. And we saw so before this whole inflation episode happened, in like 2019, the Fed did this listening event, right? They went around the country talking with consumer groups and labor unions and all sorts of people about what, about their thoughts about like the Fed and its framework and what it was doing. And most people said, like, we don't mind if there's a little bit of inflation. What we really don't want is unemployment. We really want a tight labor market. So focus on that employment side of your mandate. Don't get hung up on the price stability side. The exception was older people. So people representing like retirees, they said, there was a really good quote from that, the report on the Fed Listens. It said like, the only thing that older people fear more than death is inflation, because they didn't want their saving, like if they were living on a fixed amount of savings, they didn't want it eroded by inflation.
Well, not only are you eroding it, it's actually more than 100% tax in many cases, because if the inflation rate is higher than the interest rate you're getting on your savings, then you actually have negative savings. You're actually losing money and losing purchasing power. So yeah, the people on fixed income get hammered during high inflation.
And they're no longer earning wages that are going to start rising with inflation. So it's worth.
Let me ask you a question. But historically, have wages kept up with inflation?
I think over long periods, yeah. I mean, real wages generally have been rising. So yes, but when you get like in the short run, like in 2021, when there was, I don't know, 7 or 8% inflation, I certainly didn't get a 7 or 8% wage increase, and probably most other people didn't. But I think over longer periods of time, you can't just have sustained falling real wages.
Well, and then part of the question is what you were talking about when you were talking about the Fed and looking at what's in the CPI, right? In that, it's interesting. You said that the Fed thought that inflation was overstated, where I would tell you that most people I know think the inflation numbers are way understated, because if you look at, when you see the cost of something going up and in addition, you see the size going down. So you have that sizeflation on top of the actual inflation, then those have been, in some cases, depends on what you buy, right? Because in some cases, those have been way up. Now, if you're buying an iPad, it's gone down, but that's gone down because of technology advances and because of that supply demand type of a curve that happens naturally, right, in technology. But it's not happening, but people don't buy iPads every month. They buy bacon every month. Yeah. And bacon has tended to go up much faster. As an example, my wife loves bacon, so we buy a lot of bacon. So I notice just how much bacon has gone up. It's pretty much double from what it was during the pandemic.
Yeah, it totally depends on what you buy. The CPI or the PCE is just like the kind of consumption basket for some like average aggregate, like average household, and nobody is actually the average household. There have been a lot of different kind of government commissions over the years, or third-party commissions that investigate the CPI and say in what ways is it underestimating or overestimating, and they've made improvements to it. And the interesting thing is those commissions, when they meet, it's always driven by something political also. So often, like in World War II, right, there were some price and wage freezes And obviously not all prices were frozen. And so there was still inflation, and people realized, well, we need wages to be able to keep up with the cost of living, which is increasing. But, how are we measuring the cost of living? And workers were saying, like, no, the cost of living is really increasing faster than the official statistics say. And employers would say, no, it's not. And then they would get a government commission to come in and kind of try to settle it. And so there have been all of these studies and commissions over the years to try to improve the CPI and figure out how do we even account for the fact that, like, iPads are improving, or a car that you buy today is very different than a car you bought 30 years ago, and the price may be similar, but we're getting a different good. So it's really complicated. Nobody is facing exactly the inflation rate that's like reported on the news. We're all facing something different, and in some cases very different if we have unusual consumption habits.
So you mentioned price controls, and I know you talk about that quite a bit in your writings. So it seems to me like the government's putting money into the economy, or the Fed's putting money, or the Fed's tightening, whatever. And then lately, there's a lot of blaming of the market for causing the inflation. So it was the greedy oil companies, or it was the greedy drug manufacturers. It's greed that's causing inflation. What's your take on that? Does greed? I mean, don't consumers have a vote here that they decide? I mean, consumers more often than not decide on the price, as opposed to the quote unquote greedy company.
Yeah, I mean, companies are always trying to maximize their profits. That's what they do.
Their job.
And so sometimes maximizing their profits means they can't raise prices, and sometimes it means they can. And that depends on how much income consumers have and how much they're willing to spend. So if everyone gets stimulus checks and we have a bunch of money to spend, then companies will maximize their profits by raising their prices. If we don't have much money to spend, they won't. So it's not that their level of greed, or even like their desire for profits, changes over time. They're always trying to maximize those profits, but it's the macroeconomic conditions that kind of determine at what price they'll do that.
So if we can, I'd like to finish up with a discussion of we've got a pretty interesting election coming up, and not just for president, but for the Senate and the House. And how do you see inflation? What role will inflation, in your opinion, play based on how people look at inflation and perception of inflation? What role will that play in the election? And then how do you see things playing out in the next couple of years when it comes to inflation?
Yeah, so I have some other research with Jane Reingart and Rupal Kamdar, two co-authors of mine, and we study how Democrats and Republicans form their expectations and beliefs about inflation, and they are really polarized on this issue. So throughout, starting in the COVID pandemic and throughout 2021, and since then, Republicans expected much higher inflation than Democrats. In fact, even in 2021, when inflation was at its highest, Democrats barely, their inflation expectations barely rose at all, but Republicans rose quite a lot. And we look at how different media sources covered inflation during those times, and the more right-leaning sources were saying the government is doing all this irresponsible policy. The Fed says inflation is transitory, but how can that be? And then the more left-leaning sources were saying inflation is transitory, it's supply shocks that are going to go away. And what you get is these two very different views of the world, very different tendencies to either blame inflation on the president or blame it on corporations instead. And I mean, I think neither side likes inflation, but I think people who already would have supported Biden aren't going to blame him for it. And then people who already didn't like Biden are going to blame him for it. So I don't know if it.
So you don't think it's going to play that big of a role?
Well, I mean, I'm not a political forecaster, so it's hard to tell. But I think that
no, but historically people
historically
people have voted their pocketbooks, right?
Yeah. So I think overall it probably can't have helped Biden at all. But it's also sort of like a proxy issue where people who dislike Biden and his policies are going to just complain a lot more about inflation, and people who like Biden and his other policies are going to say, well, it started under Trump, or but look how much he brought inflation down. And you can just spin it different ways depending on what your kind of preconceptions are.
So to be clear, and you tell me if I've got the math wrong,
Okay.
but Biden didn't bring prices down. He just brought the rate of inflation down. So prices aren't lower than they were a year ago. They are still higher than they were a year ago. Just the rate that they're increasing is lower. That's
true. That's the Fed's intent, though. The Fed is not going to try to bring prices down.
So the Fed does not want to recover the inflation. The Fed says, look, this is the baseline now. Mm-hmm. This is what we're going on. We'd like 2%. And it no matter what that does to any industries, because clearly some industries are getting way hurt by the inflation, by the Fed's policies versus other portions of the economy. Always the case, right? When you tighten or loosen monetary policy. But it's just fascinating to me how people think. How do you think people will react if inflation doesn't subside? Do you think it will bother them? Do you think they'll just say, oh, well?
Yeah, I think people are a lot more attuned to inflation now than they were, right? I think before this big inflation episode, people probably wouldn't pay much attention to, oh, the CPI came out today. Was it higher or lower than expected? Only like investors would, or Fed watchers would, but most people wouldn't. But now I think it is more like kind of a front page news that's going to be heavily reported if inflation comes in a little hotter than expected. I think people are going to be just looking at it more. They've seen certain prices, especially prices that are particularly salient to them. Like for you, it might be bacon, and for a lot of people, it might be eggs, gas, rent, those kinds of things that even if like bacon is not a huge share of the CPI, but for you, it's a salient price. So people are going to look at those kinds of prices and be, I think, more sensitive to them, just because they're this whole thing kind of increased everyone's attention to inflation. We all saw that it could be a problem, right? Maybe in the past we were used to, okay, this week bacon prices went up a little, but then the next week they went down, so I'm not going to worry. But if you have a year where they're just going up and up and up, now if they start going up again, you might worry that that's going to happen again. So I think people's psychology about inflation probably will be different now for at least.
That's interesting. So, okay. So final question for you. So let's say that the Democrats win and they sweep and they have their $5 trillion tax increase. Because I'm pretty convinced that if they sweep, we will get a $5 trillion tax increase. I think they proved that in 2021, that is what they're going for. And let's assume that has inflationary pressures. Will we start seeing price controls? Because will the government then blame it on the investors and the entrepreneurs, the business owners, and therefore put in price controls, which is just a killer to those people who are investing versus those people who are consuming.
So is this tax increase, is it's planned to go along with like a commensurate spending increase?
Yes.
Okay.
Yeah. So the spending increase is they're expected to bring down the deficit by less than $1 trillion over 10 years, but they've got a $5 trillion tax increase. So by definition, that's at least a $4 trillion infusion into the economy, or moving from one segment of the economy to another segment of the economy.
Okay. So I don't know much about what these tax and spending plans actually entail. If they do turn out to be inflationary, I think there would at least be pressure for price controls on certain kinds of prices. Like, well, there's already a lot of medical related price controls, but yeah, there will be accusations of price gouging and greedflation, like we saw a few years ago. I don't think that some like broad, like World War II style price controls on like everything in the grocery stores, like I don't think that there is.
No, but you might see, for example, rent controls, because of some of the policies, we've just not seen enough building in certain areas, and so therefore that pushes up the price of rents, right? I mean, rents are solely supply demand. That is a pretty pure supply demand issue. So that's one
Rent
where
controls,
historically
yeah,
we've seen rent
plausible.
controls in that situation.
That seems plausible. I don't think like nationwide, but yeah, and like locally imposed rent controls, there already are in some places. Sure, another episode of high inflation with rapidly rising rent, I think would increase, calls for rent controls, and probably increase the amount of rent controls that were out there.
So let me ask you for your final view here is, let's say you are an entrepreneur, let's say you're a business owner.
Mm-hmm.
What do you do about it?
I
mean, one thing I heard was you need debt, right? Because debt actually benefits from inflation. So if you borrow to invest, that, and it does, that's a fact, that actually, because you're spot on, that the cost of money is lower. The cost of that money you borrowed before is a lot lower now because of inflation. So what other things do you see that that a business owner would do?
I mean, they might invest in some diversify and invest in some harder assets like property, real estate, things that they think like would do well if there were another inflation episode. I guess think about the kind of business you go into, what kinds of businesses would do well in times of high inflation. I'm not an entrepreneur to really know what those are.
But the reality is what you're studying, the people who actually play this out are the entrepreneurs and the consumers. I mean, that's all they're, right? It's really, I mean, while the government has to me, too big of a role, but they have a big role because the government keeps getting bigger, but the government's not the economy, right? The economy is business owners, investors, and consumers. That's who makes up the economy. So I do think that what you're talking about there are very practical, and there have to be practical. And I think you're spot on, actually. These are things I've talked about, that you have to look at what kind of business you're in. Are you in an inflation-proof business? Are you in a recession-proof business? Are you in, as you're investing in hard assets? I had an experience in Africa a few years ago where my guide, my safari guide was, this was in Zimbabwe, and he'd been there in Zimbabwe when the Zimbabwe dollar crashed.
Wow.
And I asked him, I said, what'd you do? He said, well, every time I got paid, I bought a goat, a pig, or a cow, hard assets, right? To deal with the inflation. I thought that was a great lesson on how to deal with inflation. So thank you so much.
Yeah, thank you.
Carola Binder, from Haverford, and the book is Shock Values, Prices, and Inflation, American Democracy. Just remember that inflation is a tax, and we do need to work on, deal with that tax as well as our other taxes. And the way we do it is getting better educated, better financially astute in what we're doing. And when we do that, we'll always make way more money and pay way less tax. Thanks, everyone.
This podcast is a presentation of Rich Dad Media Network.